How Enron fooled the world. The $63 billion lie that nobody saw coming. December 2nd, 2001. It was a Monday. 20,000 people woke up that morning and went to work. They made coffee. They checked their email. They sat at their desks inside one of the most celebrated companies in the history of American business. By the time they left that evening, their pensions were gone. Their stock options were worthless. And the company they had trusted with their careers had filed for the largest bankruptcy in United States history. $63 billion. That was the size of the lie. This is the story of how Enron built it and how no one stopped them. America's most innovative company. For 6 consecutive years, Fortune magazine named Enron the most innovative company in America. Analysts loved it. Investors loved it. Harvard Business School used it as a case study in excellence. The stock price rose from $7 in 1990 to $90 in August 2000. At its peak, Enron was worth $70 billion. It employed 20,000 people across 40 countries. It was the 7th largest company in the United States. And almost none of it was real. Enron started as a gas pipeline company in Houston, Texas in 1985. Unremarkable, regional, forgettable. Then a man named Jeffrey Skilling arrived. Skilling had a theory. He believed energy could be traded the same way banks trade currencies, like a commodity, like a stock. He called it the asset-light model. The idea was simple. Enron would not own the physical pipelines. It would own the contracts, the deals, the paper. It was a brilliant idea. It was also the foundation of everything that followed. The accounting trick that built an empire. To understand how Enron hid its losses, you need to understand one accounting method: mark-to-market accounting. In standard accounting, a company reports profit when it actually receives money. Simple, verifiable. Mark-to-market is different. Under mark-to-market rules, which Enron lobbied the SEC to approve in 1992, a company can book the estimated future value of a contract the moment it signs it. Not when the money arrives, not when the deal closes, the moment the pen hits the paper. So if Enron signed a 20-year energy contract today, it could record all 20 years of projected profit on this quarter's earnings report. Right now, today. There was only one problem. The estimates were made by Enron itself. There was no independent verification, no external audit of the projections. Enron's accountants, a firm called Arthur Andersen, signed off on numbers that Enron's own executives had generated. Who audited the auditors? This is how you build a $70 billion company out of optimistic spreadsheets and cooperative accountants. But Skilling needed more, because the projections had to keep growing, every quarter, every year. And eventually, the projections started failing. That is when they built the second machine. The special purpose entities. A CFO named Andrew Fastow had a solution for the failing projections. He would create companies. Not real companies, shell companies. Entities that existed only on paper, registered in the Cayman Islands, designed for one purpose: to absorb Enron's losses so they would never appear on Enron's own balance sheet. They called them special purpose entities. There were hundreds of them, with names like Raptor, LJM Cayman, Chuco, Some of them were named after Star Wars characters. The process was precise. When an Enron investment started losing money, Enron transferred it to one of these shell companies. The shell company absorbed the loss. Enron's books stayed clean. The stock price stayed high. But here is the critical detail. Fastow was personally running several of these shell companies. The CFO of Enron, the man responsible for its financial integrity, was simultaneously operating the entities designed to hide Enron's failures. He made $30 million doing it. The board of Enron knew. They voted to suspend the company's own code of ethics twice to allow Fastow to continue. Twice, they voted to suspend their own code of ethics. The whistleblower nobody listened to. Internal memo document. In August 2001, a vice president at Enron named Sharon Watkins wrote a memo. She sent it directly to the CEO, Kenneth Lay. In it, she described, in precise, clinical language, exactly how the company was hiding its losses. She named the structures. She explained the accounting. She predicted that when the truth emerged, Enron would, in her words, implode in a wave of accounting scandals. Lay had the memo reviewed by Enron's lawyers. The lawyers, from a firm called Vinson and Elkins, concluded there was no significant problem with the accounting. 3 months later, Enron filed for bankruptcy. Watkins was not fired, but she was moved to a different office. Her computer was searched. Her files were reviewed. The memo she had written, the one that described everything, was quietly buried. She later testified before Congress. She was called a hero. The 20,000 employees who lost their pensions called her that too. The collapse. $90 to 26 cents. In October 2001, Enron disclosed a $544 million loss and a $1.2 billion reduction in shareholder equity. It was the first crack. Investors started asking questions. Analysts who had been rating Enron a strong buy for years suddenly started reading the footnotes they had ignored. What they found there, buried in dense legal language across hundreds of pages, was the outline of the entire structure. The stock dropped from $33 to 26 cents in 6 weeks. On November 28, 2001, the credit rating agencies downgraded Enron's debt to junk status. This triggered automatic repayment clauses in the shell company agreements. The machine collapsed. On December 2, 2001, Enron filed for Chapter 11 bankruptcy. $63 billion in assets, gone. 20,000 jobs, gone. The pension funds of those 20,000 employees, which had been heavily invested in Enron stock at the company's encouragement, wiped out entirely. In the weeks before the filing, Enron's senior executives had quietly sold their own shares. Lay alone sold $70 million in stock while publicly telling employees the company was fine. He knew. What happened after? Jeffrey Skilling was convicted of federal conspiracy and securities fraud. He was sentenced to 24 years in prison. He served 12. Andrew Fastow pleaded guilty to 2 counts of conspiracy. He served 6 years. Kenneth Lay was convicted on 6 counts of fraud and conspiracy. He died of a heart attack in July 2006 before sentencing. Under U.S. law, his conviction was vacated. He died without a criminal record. Arthur Andersen, the accounting firm that signed off on the numbers, was indicted for obstruction of justice. The firm shredded documents after the investigation began. It surrendered its accounting license. 85,000 employees worldwide lost their jobs. Not a single Arthur Andersen partner went to prison. The SEC introduced the Sarbanes-Oxley Act in 2002, the most significant reform of financial regulation in decades. It required CEOs to personally certify the accuracy of financial statements. It created criminal penalties for knowingly certifying false filings. It was passed because of Enron. It may be the only lasting thing Enron built that actually worked. The question that remains. Here is what the Enron case actually tells us. It was not one rogue executive. It was not one corrupt accountant. It was a system of board members who suspended their own ethics, of analysts who stopped asking questions, of regulators who approved the accounting method that made everything possible. The lesson of Enron is not that one company was dishonest. The lesson is how many people, inside and outside that company, had the information and chose not to look. The vault stays open.